Stock splits have been a huge catalyst for some of the biggest stock gains over the past few years. Remember when Nvidia split their stock? That was the talk of the market and actually helped push shares higher. But why is that the case? And why are stock splits something that are generally pretty bullish for the market? Well, let's go to what Sam Walton said about stock splits. And this is from Walmart's announcement that they were going to split their stock in 2024. Sam Walton believed it was important to keep our share price in the range where purchasing whole shares rather than the fractions was accessible to all of our associates. So in general, the conventional wisdom used to be that you wanted your stock to be trading between about $50 and $100 per share. That number has moved up over time, but it's still the case that there are advantages to splitting your stock. Not all brokers allow for fractional shares. So having a lower share price does make the stock a little bit more accessible for some brokerages. Now, that's one of those walls that's come down over time. The trading fees are also much lower and not share-based. So those were fees in the 80s or 90s when I was beginning investing. You would pay not only a set fee, but also a fee based on the number of shares that you bought. So some of those fee structures, some of that fractionality isn't the friction that it was years ago, but there is still legacy reasons to keep your share price relatively low. It's also easier liquidity for the market. Market makers typically put lots of 100 shares in when they're trying to buy or sell a stock. And what a market maker does is they say, I will buy a stock at this price and I will sell a stock at this price. They need to have both sides of that market. And if you're putting 100 shares up on both, that could be a lot of money if that's a $700 stock price or a $1,500 stock price. Much easier to bring liquidity into the market if the stock price is $50 per share. There's also advantages for options trading. It's much more expensive to buy options on a stock that's trading for $1,500 per share than it is for a stock that's trading at $40 per share. Well, lower stock price for a stock typically means more owners are accessible in the market, and in theory, that should mean a higher price for the stock. So what are the stocks I'm looking at that should split their stock by the end of the year? I'm going to go through 10 today. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content and sign up for my newsletter, Asymmetric Investing. There's a link on the screen and a link in the show notes. You can find out all the stocks that I'm buying every single month. I buy stocks once a month, hold them long term. And along with those trades, I'm going to cover the performance, good and bad, every single week on the Sunday newsletter. So check that out if you're interested in more from me. And thanks to this video sponsor, Fiscal AI. I'm going to use Fiscal AI throughout this video, but it's the best research tool that's out there for fundamental investors. You can get 2 weeks for free of Fiscal AI Pro at fiscal.ai/ASYM, and then they'll give you 15% off if you like what you see. It's a product I pay for, so I'm putting my money where my mouth is. Let's start with one of the stocks that I own, one of the biggest positions in the asymmetric portfolio. That is Spotify. Shares of Spotify now trading for almost $700 per share. That makes it really difficult for those round lots that I talked about earlier. If you want to make a market in Spotify, have 100 shares of liquidity, that's $70,000. So very, very expensive. And you see that hasn't always been the case. 2022 shares were trading for about $80 per share. So the stock has run up so far that at some point you need to split your stock. And that's what I think Spotify needs to consider is, given this stock price, it's hard to trade options, it's hard to have those round lots. It's time to bring that stock price down. And this isn't the only company in streaming where that's the case. Netflix is even more expensive, $1,200 per share. Again, hasn't always been the case. Let's go to the max. Even back in 2022, shares were $186 per share. But the absolutely crazy run up over the past couple of years has put this stock at a point where you're putting over $120,000 in to buy one of those round lots or sell one of those round lots. So that's very, very expensive to make liquidity in the market, even if you have high trading volume. Another popular stock that falls into this category is Costco. Costco trades for $950 per share today. Again, management may not want to split that stock, but eventually you get to a point where the stock price is so high that it just becomes unattainable to buy a full share for a lot of investors. And remember, a lot of investors today are investing much smaller amounts, putting $50 into a stock, $100 into a stock. You want to make that accessible so you're not buying 0.001 shares of a stock for that amount of money. So I think Costco could easily do a 10-for-1 stock split where you get 10 shares for each share that you own. That would bring that stock price under $100 per share, maybe make it more accessible to more investors. Microsoft is in the same boat. Microsoft, $507 per share. Again, hasn't always been the case, and this is a stock that has been split over time. Here you can see they split the stock in 1987, 1990, 91, 92, 94, 96, 98, 99, 2003, And then they just stopped splitting the stock. The stock obviously didn't go anywhere for quite a while between 2003 and about 2016. But now we are at the point where it is time to split that stock. Meta Platforms is another stock that has gotten so expensive, it's well out of reach for a lot of new investors to be buying a full share, $704 per share as I'm recording. And again, as recently as late in 2022, the stock was only about $100 per share. So that's an opportunity. You could do a 7-for-1 split, an 8-for-1 split, get that stock price down to a little under $100 per share and make it more accessible for liquidity and for options purposes as well. Coinbase has been all over the place since going public, but now we're at the point where at $400 per share, you can bring that stock price down pretty significantly with a 4 or 5-to-1 stock split, get it under $100 per share. And this is the kind of stock that is going to be volatile because a lot of investors do like to trade options in a company like Coinbase. So I think this is another one. This is in the asymmetric portfolio as well. A great opportunity to split that stock and maybe even help improve the value of Coinbase, now over $100 billion in value. But that could actually be bumped up if you make the stock a little bit more accessible to more investors. One that has grown into its valuation is Axon. This is one that I was buying over a decade ago at this point, and they have just grown tremendously. Let's look at this max chart. You can see that 50 cents per share based on today's number of shares outstanding in 2021. So just a phenomenal run for Axon, but now with shares at over $750 per share, opportunity to do probably a 10-for-1 stock split, bring that stock price down and make it more accessible. And again, this is one of those growth companies that retail investors are very interested in. So you want to make that stock price accessible for more and more people to buy your stock. Eli Lilly, number 8 on my list, $772 per share. Seems like a lot of these stocks are in that $700 per share range, but about a $700 billion market cap. And again, to make it more accessible, and this has been on a crazy run from about $151 per share in 2020, now over $770 per share. You could do another pretty big stock split in this one as well. ServiceNow, one of the big SaaS companies, another company that is getting a lot of attention because of artificial intelligence, nearly $1,000 per share. So again, like Sam Walton said, that makes it very tough for a lot of regular employees even to buy full shares of stock. Even if it's just feeling better about owning 10 shares after a 10-for-1 split, there are psychological benefits to having a little bit lower stock price and doing these stock splits. The final one is MicroStrategy, or Strategy as they are calling themselves now, $423 per share. Just a crazy run, but you can see that this was $50 per share in January 2024. So up nearly 10x since then. But let's bring more retail investors. I don't know if they necessarily need that, but more retail investors, a lower stock price also would make it much more feasible to trade those options. I've looked at those options with MicroStrategy, actually on the short side, but they just become very, very expensive when you have a stock that's trading for over $400 per share. So those are 10 stocks that I think should be doing a split in 2025. It's time for them to bring that stock price down because it does make liquidity easier to bring into the market, makes options trading easier. And even if it's just psychological, you remember you own the same piece of a business, whether you own $500 of a stock trading for $500 or $500 of a stock trading for $5. You own the same sliver of the business, but just psychologically, it feels better for a lot of investors to just own more shares or even whole shares rather than just fractions of a share. So those are some of the reasons to split stocks in 10 stocks that I think could do that. Maybe even get a little bit of catalyst out of them. Let me know which one of these stocks you want to see split in 2025. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing, my newsletter. Again, a link on the screen and a link in the show notes. Thanks for watching, everybody. See you here next time.